Hi to everybody out there. Just wanted to let you know that we're going to get things going in about 5 minutes. This is Brian Gordon speaking. And so just sit tight while people are coming into the webinar room. And we will get things going in just about, just about 3 minutes from now. Thanks. Okay, so I just want to welcome everybody to this Level 3 webinar where we're going to talk about material from Study Session 9, Currency Management and Introduction. My name is Brian Gordon, and I am the Director of Learning at Exam Success. I'm the founder of Exam Success. I've been teaching CFA study programs since 1999. So a long time. I've seen this curriculum change over the years. And now at Level 3, I can see that we are on the horizon for earning the charter. So what we need to do is put together a strategy on how to attack this material so that when we come up to exam questions, we're able to provide the grader with the opportunity to be able to award us as many points as possible. That's what this Level 3 is all about. It's about getting part marks. I don't believe that there's any perfect answers. So when you are studying on your own and you're going through your guideline answers that have been published by CFA Institute, those may be for tutorial purposes. They may be, perfect answers, or there may even be solutions and other answers that are acceptable. But I think what you should be looking for is to be able to get an overall view of what the content is about, and then start to think about how these questions are going to come at us. And through my program, whether it's online or in class in Toronto, we emphasize a lot of practical approach to taking this material and translating it into potential CFA exam questions, working through a lot of questions. I think that's really the skill that I think you need to develop. And I think that you need to learn how to answer these questions in what I call the CFA way. So in this webinar, we're going to cover this material from the reading in study session 9 about the currency. And I just want to show you examples of how we approach this. You'll see this is a sample from our study notes, and they cover the curriculum. We follow through the learning outcome statements and then focus in on examples. And whether we're in class or whether you're participating online through our total study program, a big emphasis then is now translating that knowledge to actual past CFA exam questions. They're all published by CFA Institute, going through those and then critiquing our answers so that we can be ready for the exam. So without any further ado, let's just jump into this material. And we'll go right down here to currency management and introduction. And you'll notice right away that our approach is a little bit different. There's a lot of hands-on commentary, my tips, the professor's tips, and exam tips, so that you are guided along the way, because we really want to make sure that what you're looking at is being able to apply this knowledge to answer your CFA questions. And that's what's really critical. So this currency management, if we start looking at these learning outcome statements, they seem relatively basic, relatively easy. Analyzing effects of currency movements on portfolio risk and return, discussing strategic choices in currency management, and the appropriate currency management program given the facts about a client, their objectives and constraints. And I think this is really what's critical in terms of us being able to crack this CFA code. I think that's what we really need to get our hands on. So we're going to work through some of these examples here and go through these items. That's what I think we really need to be able to take away. So let's just get into this here, just onto our next page here. So just some background here in terms of what to expect. I think that you'll see questions that could be in the morning session or in the afternoon in the item set. So essay and item set. I think back in 2015, there was a nice essay question on this material. It's a really good example of what you can expect to see. So having said that, I think that, again, we just need to know the general concepts and then start working through questions, be able to apply this material, this knowledge. So that's what we're doing here. So let's move through this currency and, just a review of the basics here in case you've forgotten some of these about the quotations. I think it's really important that we know how to, what a currency quotation is. And so we're looking at these quotations in terms of a currency pair. And I think you got to know that type of language. And the currency pair with the price currency in the numerator and the base the base currency down in the denominator. I think you need to know this. And so if you're given a quotation that says something like US dollars per euro, you know that the US dollar is in the numerator. It's the price currency, and the euro is in the denominator. That's really what I think that we need to take away here. So just following through here on our material, I think that we really get down to the basics here, just in terms of our quotation. The next thing that I think that we really need to be able to focus in on here is being able to understand what currency is trading at a premium, what currency is trading at a discount, and I think that is what is critical from our material. Just the basics here. We're focused on the base currency, so we know when the forward's trading higher than the spot that the currency is trading at a premium. Well, the question becomes, what currency? Well, it's focused on the base currency. So if we have a situation where the forward's higher than the spot, we know it's the base currency is trading at a premium. And then by definition, the price currency must be trading at a discount. So keep that in mind as you work through this material. So just really, a little bit of the base here, knowledge, maybe a little bit of review. You'll hear me say a lot here, think like a level 1 candidate, because that's really where it comes from here. The question of which currency is trading at a premium or discount here, that is really what we're looking at in terms of the base currency, okay? So now I just am looking at this material and just want to make sure that it is being broadcast to you. And, we're just, these notes will be sent out to all participants. And if you were not able to participate, then you will get a copy as well. So in this case, I just want you to be aware that if it's not following through, you will be able to get the copy to follow, and you'll be able to focus in on the rebroadcast to catch up. So as we move forward, they may start talking about forward and spots in terms of the points. So back to some level 1, level 2 material, just looking in at the points. And how do we handle questions? We know that the forward has to be equal to the spot plus or minus the points. So we can see, from our learning example here, I've got a currency pair of US per euro, and so from this material, we can see from the chart here, we can see right away from the points, we can see whether the currency is trading at a premium or at a discount. And these points then refer to the base currency. So right away, I can tell the euro is trading at a premium. The points down here at the bottom, I can tell that they're referring to the Canadian dollar, the CAD. It's trading at a forward discount relative to the British pound. So just a real quick refresher, and if you're comfortable with this material, you don't have to pause here. So our material walks you through from the basics right up to the exam level. So I was just trying to think about this from a tutorial purpose. We answered question number 1, and we can answer questions 2 and 3. These again, are they level 3 material, or maybe are they just a review from level 1, level 2? But you never know. You may need to use this. Could you calculate the forward exchange rate? Sure. We could calculate that forward exchange rate as just being equal to the spot, which is 1.0155, in this case, plus the points. And the points are going to be 125, and these points are scaled by 10,000. So when we do our calculation, we'll find that the forward is 1.028, and now we can work from here. In question 3, could we work from the forward back to the spot? And we certainly could. And just remember, the key here is to do the math correctly. If we have the spot is equal to the forward, and then we're going to subtract the points, we got to make sure that we do the math correctly. So in this example, we have negative points. So let me just scroll down to give us a little bit of space here, and just make sure that you do the math correctly. Spot is equal to the forward, 0.55, minus, and now it's minus 80 points divided by 10,000. And now we've got minus a minus. We're going to have to add this. So we will end up getting the spot at 0.558. And, just to think about it logically, if we were talking about a forward, a discount, then the spot has to be higher than the forward. So this was just a little bit of a warm-up just to get you going. Is it level 3 material? I doubt it's going to be level 3 material, but just the foundation here. So then our readings want us just to go back. Let me go past our solutions. Go back into now the basics, just to talk about transactions. And this first one is referred to as a FX swap. And the FX swap, do not confuse this. This is not, the same as a currency swap. Okay, that may be obvious. So what we're just trying to do here is think about this from the portfolio manager's point of view. The portfolio manager's point of view, where we hold foreign currency assets. So the foreign currency assets. So we have the exposure. And now what we've done is we've hedged. So what we've done to hedge is we hold a short position in a forward contract. And now this forward contract is coming close to expiration, and we want to roll this over. That is the scenario of what's going on. So now we just need to be concerned about the language here, whether this is a matched or mismatched swap, because this will tell us the correct exchange rates to use, what to use. So I gave you the definitions here. And, if we jump right down to a learning example, I mean, this is really what we have to focus in on, because on our exam, I think they're going to give us a lot of detail, and you just have to recognize what you're looking at. So what are we looking at here? Well, we have a Canadian portfolio manager, and they hold Mexican peso securities. And so what have we done? We've sold the Mexican peso forward. All right, great. So that's to cover us. So we can get that back to Canadian. We're hedged. But this is going to expire in a few days. So we want to roll over this hedge. We want to see, carry on this protective position. So now we're looking at the quotation. And what's very important is to look at the currency pair. They gave us Mexican peso per Canadian dollar. They gave us the spot rate. They gave us the bid and the ask. And then they gave us the forward points, the bid and the ask. So we got to keep this in mind here. We have the bid and we have the ask in terms of these quotations. And over here in the points, we have the bid and we have the ask again. So we're going to need to make sure that we put this together. So just as a tutorial, I just threw this in here. What exchange rate would be for the first leg of the swap? So this language again, what is the first leg? So the first leg refers to the transaction where we are now buying back the forward, which we have sold. Remember that we've sold it to close out our position. So just remember what we're doing is we are going to we're buying back. I mean, you're not going to see that written down, in the text. The forward. Okay, to close the position. And so now, since we're buying back this forward, well, what are we doing this at? Well, since we are matching the underlying amount, this is referred to as a matched swap. So the exchange rate that we will use, remember, we are buying this back right now. So this is going to be done at the spot. So make sure that we know this. And it's going to be done at the midpoint of the exchange. So 9.1 and 9.3, the midpoint, which is going to be equal to a 9.2. That will be the exchange rate for the first leg of the swap, to close out the swap. All right. Now, that's not the exciting part. Let's go to part two. Part two says at what exchange rate would be for the second leg of the swap. So just to be aware, what is the second leg? This is now where we are reestablishing the hedge. So here's what we're thinking. We think, okay, that we want to sell the forward. That's what we're thinking. We're thinking about selling the forward to establish the hedge. All right, that's fine. But I want you to, watch out. Okay, this is going to be the trick. You got to watch out. You must look at the currency pair. And the currency pair that's given, here it is. We're given Mexican per Canadian. So we're given MEX per CAD. And now if we sell forward here, then we are actually selling the CAD forward, which is not what we want to do. So we must really be careful in terms of what we are accomplishing for this, this transaction. And it all comes down to the currency pair which is being given. So I think that you got to pay attention here to this currency pair. So in this case, let's just say In this case, what we're going to do is we're actually going to buy the forward. Hey, I know that sounds strange, but buying the forward to reestablish the hedge, because what is buying the forward going to do? It's going to lock in a price to buy the CAD, and then by definition, if we're buying the CAD, then we're going to be selling the Mexican peso. So, I mean, that is really the trick, and we got to watch out for this. This will be what I think you need to take away from this exam, is really paying attention to what you're looking at. So, if I scroll down to our answers here, sure, we've got the midpoint. Now, on the second question, I didn't calculate the spot. So I didn't calculate the forward exchange. But let's just carry on from our thinking here. Remember, we were buying the base currency. We were buying the CAD. Why were we buying the CAD? Because the currency pair was being given this way. So we're going to use the midpoint now plus the points. And which points are we going to use? Well, since we're buying, we're going to use the ask points. So this is very important. Let me just scroll back up here so you can see this. Okay, so you can see this. Now, remember, in question 2 here, where it says, what would the exchange rate be for the second leg? So what are we doing? Well, you think about hedging. So you normally think about selling. No, that's not going to occur here. Watch out. Look at the currency pair. The currency pair is given as Mexican peso per Canadian. So if we sell this forward, that means we're selling Canadian, which is not what we want to do to hedge. We want to buy the forward, which is going to then lock in the price to buy the Canadian, and then by definition, lock in the price to sell the Mexican peso, which is what we want. Now, what exchange rate are we going to do? Well, we're going to use the midpoint of the bid and ask, and now we got to come over to the points. And remember, because we are buying the forward, we're going to buy at the ask. So we're going to use the ask points. This is what is really critical. So if I scroll back down to our answer now, we can put it together here. So we're selling the Mexican peso. Yes, I know that, which is the same thing as buying the Canadian. Since the Canadian's given as the base currency, we're buying the Canadian. We're going to use the ask points. That's what's critical here if we need to do this. So I want you to think about this, and I put together a little exercise for you just to clarify, because it's really critical to recognize what the currency pair is and what we are doing. So just to clarify, here's another example. Let's say we are a U.S. manager, and that is our home currency. And we are long assets in euros. That is our exposure. So to hedge the risk, of course, we want to be able to sell euros. Okay? I mean, obviously, to hedge the risk. So now, how do we accomplish this hedging? If the quotation, if the currency pair is given as US dollar per euro, then what we want to do is go ahead and short this forward contract. Shorting this forward means that we are selling the euro, selling the base, and buying the price currency, which is exactly what we want. Now, notice down here, if the currency pair is given as euro per US dollar, now to hedge, we want to go long this forward contract, because that means we're buying US dollars and selling euros. This is something that I just want you to think about, because I think you need to let it let it sink in, because it will be the foundation for some of the questions, whether these are item sets, and you got to look at the information that's given. And we will see this theme come up again as we go through the material. Okay, so from here, let's carry on now to where our learning outcome statements want us to talk about the effects of currency on portfolio risk and return. So we start off with an exam tip. What I want you to think about, and you'll see how it related back to the previous examples. I want you to, when you're attacking these questions, I want you first to think about what's their home currency. Okay, don't get caught up with domestic and foreign, because that might throw you off. What's their home currency? And okay, that can be the domestic currency. Okay, but really, I want you to start with the home currency. And then I just want you to think about, what are their investments? What currency are their investments in? What are the exposures? And that's exactly the procedure that we went through in the previous example. And now we can start to think about what actions we need for hedging. I want you to focus on the currency pair. And remember, the currency pair, the way it's written on the paper, will tell you what to do. And I know if it's multiple choice questions, there may be two answers that look the same, but depending upon the currency pair, give us different conclusions. So I want you to focus on the currency pair, and I want you to focus on the base currency. That is the issue. And then we can do calculations. So this is the framework to get you into cracking the code for these questions as they can show up on this exam. And you will see them show up. Take a look back at the 2015 Level 3 exam, and you'll see a nice essay question there. And again, pretty similar format. So some basics here. Of course, we know about risk and return. If we're holding assets in our home currency, there's no currency risk. So we're talking about holding assets in foreign currencies. And I just want you to, do you have to memorize these formulas? Possibly, but I just want you to know that the return, we're thinking about the return in our home currency. And this is equal to the return in the foreign currency. And then we got to think about plus or minus what happens to the exchange rate. What happens to the currency movement? And so I just say plus or minus the exchange rate. The textbook says the return FX. What does this return FX refer to? That is the key. So this return, or this movement in the exchange rate, you got to link it back to the currency pair. And again, this return FX, we got to think about this in terms of the foreign currency. So it's very important that you know that your quotations are going to be given in terms of a quotation of, and let me put it right over here, domestic currency or home currency over foreign currency, or the currency that your investments are in. So don't, I even though I typed it here, I should not, I was lazy. Don't get caught up domestic, foreign, home currency over the currency that you're invested in. And, this is, I want to give you these plain language tips so you know what to do on the exam. Formally, if we wanted to calculate this exactly, here's the geometric linking: 1 plus the return in foreign currency over 1 plus the exchange rate movement. Subtract 1, multiply it by 100, and we can get our answer. So just be aware, okay? Now, what else can I think about here? I just said in other language, the investor's domestic currency is always the price currency. We've got that listed up here. Price is in the numerator. If we had more than one foreign currency, investment, foreign currency in our portfolio, we could calculate a weighted average. This is kind of like level 1 material. Okay, I don't know if it's going to be on our exam, but I mean, if it's there, I think we got to nail it. So I just, I simplified the formula. Don't start getting, too technical. The weighted average. Think about all the returns in each of these currencies. Now, on the risk side, what are we talking about? We're talking about just like, level 1 thinking, portfolio variance. So variance If I have just one currency, so it's just a very simple formula. Think about portfolio variance without the weightings. If I had multiple currencies, I could think about the variance in here. This is two currencies. I have the weighting and security in currency one, the variance of returns of currency one, and so on. Just like our level one formula for portfolio variance, or if I take the square root, portfolio standard deviation times 2 times the weighting in 1, weighting in 2, standard deviation of 1, standard deviation of 2, the correlation between the two currencies as well. So the bottom line here, maybe there'll be a simple question on risk and return, but takes us right back to our level one thinking. Okay, that's what I want you to take away here from this material. So, our learning outcome statements certainly do say to analyze the effects on risk and return. So the bottom line as well, they can enhance our return, or they certainly affect our return, and they can also affect the risk. So now the learning outcome statements then want us to get down to starting to talk about this currency management, the hedging. So again, the bottom line that we're thinking about is, should we hedge or should we leave the portfolio unhedged? And this, I really think, is going to be a CFA question, and it sets itself up well because, like I say here, it gives us exposure to a lot of learning outcome statements and connects together much of the curriculum. So now I want you just to think in simple terms. Don't get carried away. The most basic reasons for hedging it and leaving a portfolio unhedged. Textbook knowledge. If you've got knowledge somewhere else in terms of expertise, leave it until the day after the exam. So what do they tell us in our textbook? Well, they could use different language here. Okay, so I could start to think about this and start thinking, can I pick up some of their signals? If they start talking about things like harvesting alpha. What is that? I just threw it in here. I wanted you to be aware of that term. It's actually a term, and it relates to actively trading the currency to try to enhance your returns. So it links right down here to our strategic choices. So from our textbook, they talk about this, and we've got three basic choices. Hedging the currency risk. There's choice number one. Leave the portfolio unhedged. That's choice number two. And this may come from thinking sure. In the long run we tend to revert to our mean, so things seem to even out. I don't think that's our CFA. Don't worry about that part. Or the third strategy, actively trading these foreign currencies to enhance returns. So we've got three different potential strategies. Now, our textbook wants us to talk about this, and we have to get into the language. So I highlighted the language, and I think that you will have to recognize some of these signals from the curriculum. So passive investing. Now, I think that what you need to take away from this is our neutral position. They could say on the exam, they could use that language, the neutral position. And the neutral position refers to passive investing. It refers to, I hope that this stays there. This refers to simply creating our portfolio currency exposure and matching it to the benchmark currency exposure. So that's it. We're just matching the exposure. And are you going to do this? No, you're not. It's just a qualitative answer. Now, what else do you need to take away from this? Passive hedging. So what are we trying to do here? Well, I think that the key that you're going to take away is that there's no discretion, no portfolio manager discretion. And this is the key. So it's rules based, as they say in the curriculum. Okay, and the portfolio manager, that's it. We match the benchmark currency exposures, and that's it. And this benchmark may have no foreign currency exposure. So I think that you need to take this away. They might talk about discretion, passive hedging, matching the benchmark currency exposures, it's called a neutral position, and the portfolio manager has no discretion. Now, that leads us right into discretionary hedging, okay, where again we may match the portfolio currency exposure to the benchmark currency exposure, but the manager now has the ability to let these exposures drift slightly. Okay? They can differ from the neutral position. I think that's the key. So difference between passive and discretionary, obviously, is the manager now has the ability, based on their discretion, to stray from the neutral position. Active currency management now, well, of course, now what are we doing? This is the extension of the discretionary. So, I mean, if I just add it in here, I'm just trying to think about a theme of how they can, apply this. Just think about, full discretionary. That's I think I need an R in there, and discretionary powers for the portfolio manager. So now they're actively managing and they're trying to enhance returns. There may be some limits, but think about it as that extension to discretionary, where they're still matching that currency exposure of the portfolio to the benchmark with a little bit of a drift. Now we have full discretion. Currency overlay, dropping this in here. I mean, I can just draw a line here, completely different. Currency overlay, all you're doing is looking at hiring an outside manager, an expert, someone who can actively manage the currency. They have the expertise. That's all. I don't think you're taking away any more from this. So, what are our choices between this passive and discretionary and active management? It may just come down to the costs associated with each, the benefits, in terms of additional return. We may even have to look at things in the IPS. There may be comments by the investor, comments by the investment professional that you may have to pick up on from the question, but that's it. So again, just the language, think about this terminology. Then the learning outcome statement changed, and now they want us to talk about, thinking about this currency management now, and really relating it to market facts and the client's objectives and constraints. So just to translate this back to simple thinking, going through the textbook here, just want you to be aware, okay, of what we're talking about here. So if we have a short time horizon, then we should probably be more fully hedged. I think that's the link that you got to take away. And so we want to be more fully hedged. If we have a low tolerance for risk, then again, fully hedged, closer to being fully hedged. It may not be exactly fully hedged, but you get the notion. So someone who has a low tolerance for risk, or they might even say high risk aversion. Okay, so I mean, just remember that low tolerance for risk, high risk aversion. So again, more fully hedged. Someone who has liquidity needs, higher liquidity needs, closer to being more fully hedged. And the opposite works for these type of relationships as well. So that I want you to put together. What about income needs? The textbook talked about this and just said, yeah, if we have, if we need income, then probably closer to being fully hedged again. What about if they talk about the larger the percentage of our exposure to foreign assets? Then it makes sense. Yeah, hey, we've got a large exposure there. It might make sense from a cost-benefit point of view to be hedged. Costs, they mentioned that as well. How about low costs? The lower the costs, the cheaper it is to hedge. So these are, they're not really difficult, but don't lose your head in the exam. Just think about the most basic relationship. If markets are volatile, they talked about financial markets, the higher the volatility, boy, we probably would prefer to be more fully hedged. That's what we're thinking about. If you have any doubt about the skills or ability of the manager, yeah, then just be fully hedged. Why? That takes away any of their guesswork. And if we want to view the currencies as a separate asset class, if we want to view them as a way to increase our returns, well, then of course you don't want to be hedged. Oh yeah, I want to manage these and try to add alpha, try to add a little extra return. Then you don't want to be hedged. So, okay, really basic here. I mean, that's our learning outcome statement. That's how we're tying together market facts and client objectives. You're just going to read this straight from the question. That's it. And then put it together. So think about the most basic relationships here, and that's it. You're not going any further. Then they mentioned that we might be trading based on technical analysis. So do you have to go back to, technical analysis. They want us to talk about currency trading strategies. These are active trading strategies. Tactical decisions is what I was focused in on. So the tactical decisions that they refer to are based on economic fundamentals, technical analysis, the carry trade that we'll talk about, and volatility. So this economic fundamentals, again, really back to basic thinking, level one thinking here, thinking about the real exchange rate, thinking about interest rates, just nominal rates or interest rate differentials, thinking about expected, or just think about inflation, think about risk premiums. I'm just going to fill this in. And well, we could even think about reversion to the mean, but let's just stop at these first couple here. And think about this. So if real interest rates are high or increasing, then what would we expect? Well, then we would expect the currency, let's say the base currency, let's say that's the home currency, we'd expect that base currency to appreciate. If we think interest rates are going to increase, or the differential is going to increase, then you think your currency is going to appreciate again. And remember, your currency is in the base. That's what we're thinking. And now I wrote this in here: the foreign inflation is expected to increase. Well, okay, just we could turn this around. Just if you think inflation is going to rise, that's bad for your currency. The purchasing power decreases. So here, make sure you note that I'm talking about the foreign countries' expected inflation. If that increases, then the home currency, the base currency, will appreciate. If I wanted to add to this, if I wanted to say an increase in let's see here, in the home country's expected inflation, well, what would happen here? Well, the home currency would depreciate. That's what I would think about. So just make sure you know about whether in the question they talk about the foreign country or the home countries, their inflation. And then risk premiums, again, the same argument. Make sure you know about whether they're talking about foreign risk premium or the home country, okay? So here I've got an increase in, let's say, the home country's RP, the risk premiums. In this case, the currency would depreciate. Okay, so just filling in this chart. It's common sense. Just think about it in basic terms. And, thinking about reversion to the mean, if the real exchange rate is below the long run average value, we should rise up. So we would expect an appreciation. And I could think about the opposite. What if we were below that long-term, the long run value? So I'm just trying to think about some of these basic items here, okay? Don't get carried away. This information is going to be worked into the questions. So we'll link this. I've got an example that we'll come across when I get down a little bit later on in this presentation. Technical analysis. The only thing that I want you to think about here, okay, is we look at prices for signals. We look at historical patterns, and those tend to repeat. There's a focus on emotions here. Where will the currency trade at? Not values and what should the currency trade at. That's all nice to know. And here it's no stronger point than to say level one thinking. Okay, I mean, right back, level one, they talk about the fundamentals, the basics, the assumptions of technical analysis. Do you have to know language about overbought and oversold, these leading to reversals or corrections, I think they were talking about? I doubt it, okay? But just thinking about this language here, do you need to know about support, resistance, and moving average? No, don't go anywhere near there, okay? So I think, from questions I've seen, they focused on the economic fundamentals in their questions. So keep that in mind. Now, now they want us to talk about the carry trade. So now just draw a line here, completely separate. They would have to focus in on this carry trade, and they would have to say something like, the client, the investor, or the advisor believes that interest rate parity, does not hold. That is their belief, and this is what the carry trade is based on. So now, just in this box down below here, so interest rate parity says what the currency movement, the percentage change in the exchange rate should be equal to the interest rate differential. What you gain or lose on the interest rate differential should be offset by the currency movement. Otherwise, there's an arbitrage opportunity. Well, the carry trade says this does not hold. So this is, what our textbook starts to refer to as in terms of trading on the forward rate bias. Okay, when this interest rate parity does not hold, you can look for language, in terms of, something like where they might just say, if I can fit this in here, let's say trading on the forward rate bias, and that's what they're talking about here in terms of this FX carry, and where we start to talk about the funding currency and the investing currency. So we just need to know the language. Okay, so here's that forward rate bias. So what do we talk about here? Well, we're going to borrow the low yield currency and we're going to invest in the high yield currency. And so that's it. Don't go any further. Okay, do not go any further. I don't think you're going to be rewarded for this. So trading on the forward rate bias, I threw it in here because they could just use that language. And this selling the currency that's trading at a forward premium, buying the currency that's trading at a forward discount. This is equivalent to borrowing the low yield and investing in the high yield currencies. They are equivalent statements, and you may just have to think about it. Other trivial points just to be aware of. Remember, this is the level 3 exam, so we've got to integrate these items. Because we're looking at this in terms of payoffs, where there may be, a really large loss. This large loss could occur. This gives the payoff a negative skew. And when we are looking at our portfolio management, we think about things in terms of normal distributions. Okay, so we think about things that do not have a skew. So this negative skew really means watch out. There could be large losses on the downside. So that's really what we're looking at here. And this may be even non-linear. Okay? So when we start to talk about items in terms of risk management, and you might look at items such as your VAR calculations and things may not give us the true risk exposure. So maybe that's going a little too far. But I just want you to be aware of this negative skew. I want you to be aware that this is a leverage position because we're borrowing the low yield currency. This may intensify and magnify the risk. Okay, these positions are hard to unwind. Okay, so you can't unwind them really quickly, which again may lead to large losses. For the FX trade, you're really hoping that there's low volatility. I mean, if there's a volatility, then this is not the friend of the FX carry trade, professional here. If there's a lot of volatility, oh wow, that could lead to large losses. So I put the line in here: low volatility is better for these FX carry positions, for traders who have these open positions. So great. Where does this take us to? Well, an example of what we might see on this exam. So here's again a chart, a table. So what do we have? We've got three different currencies, and we've got the CAD, the Japanese yen, we've got the British pound. They gave us the risk-free rates, the short-term rates. They also told us here that the CAD, the Canadian dollar, is expected to appreciate by 80 basis points, or 0.8% versus the British pound. The Japanese yen is expected to appreciate by 1% versus the British pound. Just use the information that's given. Do not overthink the question. So using this information, just for tutorial purposes, we have identify the funding currency and investing currencies to implement a carry trade between the British pound and the Canadian dollar, the CAD. So the funding currency, well, remember, this is the low yielding currency. So if I come back to my table, I guess that's the Canadian. The Canadian is definitely at a lower yield than the British pound. And if I drop down here, the investing currency, well, that would be the British pound, because that's the high yield currency. If I wanted to take this a step further, and I don't know, this might be more from level 2, but just to put it together, if we wanted the profit from the carry trade, then the profit from the carry trade is really the interest rate differential, I minus I. And so let me just make those as small i's for so we don't confuse this with inflation. And then we're going to subtract off from this. We're going to subtract off the percentage change in the exchange rate. That's how I'm going to write it here: the percentage change in the exchange rate. So now we just have to fill this in. What interest rate? Well, this would be following our quotations, and the quotation for our exchange rate had better be high over low. The high yielding currency is the price currency. The low yielding currency is the base currency. So high over low. This had better be the high yielding currency minus the low yielding currency. So if we fill this in, we can calculate the profit equal to, well, let's see, the interest rate differential, 3.15% minus 2.05%. I'll leave the percentages off. Minus now the percentage change in the exchange rate. And this is the high over low. Well, they gave us the exchange rate for the Canadian dollar, the appreciation versus the British pound. The low yielding currency is the Canadian currency. So remember, right back from page 1. So I will subtract off 0.8%. And if we do this math, I think we end up with a profit of 0.3%. There it is. That would be our profit. So again, a real simple exercise. Let me just pull up the second question here. It just says, identify the currency pair that would result in the greatest profit potential on a carry trade. So really what I just wanted you to know from this was just to know that the larger the interest rate differential, then the larger the potential profit from a carry trade. That's it. So, I mean, that's all I really wanted you to take away. So the carry trade, how do I see it working into this exam? I see it working into this exam maybe in a definition, maybe just knowing to recognize, the relationship here. But that would be it. Recognizing the language. if the investment professional believes that interest rate parity does not hold, what's the strategy? The FX carry trade. That's what I think you need to take away, the strategy. So let's just move forward past our example and past our solutions. And now we're into the strategies based on volatility. So the volatility strategies, this now brings in our material on options. So options is what we're focused in on here. Remember, forward contracts, volatility is not a factor influencing value. So what do we need to know? We need to know the language. Delta neutral. What is a delta neutral position? A delta neutral position, I think we need to know this. Okay? It is a position that removes price risk. Okay, that's fantastic. Again, something nice it says in the textbook. So what does this mean? Well, what it means is we're going to use a forward contract to offset our exposure to price risk. And the example, let me just drop down here to an example here. Let's assume we have a manager that is long a 50 delta call option on the CAD per Swiss franc currency pair. So first of all, what does this mean? We're long a call option. So how can we remove the price risk? Forget about what 50 delta means. So how do we remove the price risk? If this is a multiple choice question or an essay question, I'm looking for. So I'm looking for an answer, okay? And the answer is going to have something to do with, in this case here, shorting a forward. Okay, so I better be looking to short a forward in the currency pair. I got to make sure I have this CAD per Swiss franc. I got to make sure that the currency pair is the same. So that's what I'm looking for. I'm looking for an answer that says shorting the forward. Okay. Now the question is going to be, to complete it, to get all the marks, is how much? Okay. So how much do we need to short? What is the amount for the contract is what we're after. That is where we'll put together this delta. Okay, and you know what a delta is from basic option theory. That tells us how the option changes when the underlying changes. It tells us something about the price risk. So what is this interpretation of delta 50? Well, what this tells me is a little bit of information. So in the currency options, we start to talk about options in terms of deltas, not necessarily in terms of premiums. So for a call option, the delta ranges from 0 to +1. I think we know that. And a delta of 0.5 or 50, because they start to talk about these in terms of percentages, means that we are at the money. So a 50 delta option means that we are exactly at the money. We've got a delta of 0.5. That's what it means. So we have a delta equal to +0.5. So now we can start to use this. If I have an option on a currency pair that's based on 100,000, that's the contract size. Well, now I know I can go and short a forward contract, and the multiplier is just going to be 0.5. So we're going to be shorting a forward contract based on the CAD per Swiss franc that has a contract size of 50,000. This came from the delta. So we just have to put that together. Okay, so maybe this is a simplified example, but it's, again, coming down to what you're looking at. So just the basics here. Delta neutral means we're removing the price risk. How do we remove the price risk? Well, here it is. We're going to use a forward contract. That's probably how we're going to do it. Once we have removed the forward contract, we can now trade on the volatility. That is really what we're after. And trading on the volatility now, we can look at strategies. This is what you're going to be looking for on the exam now. Straddles or strangles. Okay? And so, just remember that a straddle is a combination here. So let's see here. The straddle is a combination. It's at the money, where we are long a put option and we are long a call option on the currency pair. So what we're hoping for, so we hope that there is a lot of volatility. That's what we want with the long straddle. Okay, this is a long straddle position. Long the put, long the call. We're hoping for this. So you're looking for this on the exam. I mean, this is really where we can pull out the old questions, and that's what we do in class or through the online. You can start to go through some of these old questions and now put it together so you know what to look for. We're anticipating this. So a long straddle position. If I had a short straddle, then I'm thinking that there's just going to be not very much volatility, and I'm trying to capture the premiums. That's it. That's all we're looking at here. Okay? So keep this in mind. The key is to look at these examples, okay, of how to put this together. So the other part to think about is the interpretation of the cost as we increase the delta. And we talk about this in absolute terms. So don't think about put options having a delta from -1 to 0. Both put and call options, just think about them in absolute terms. The higher the delta, the more expensive. So a 10 delta contract would be less expensive than a 25 delta contract. That is the issue. So they might have questions that relate to, if they say cost is an issue, look for the lower delta call or put options to use. Okay, so that's what's critical here. So now let's just look at question number 2 here. Question number 2 says, suppose the manager's has holdings in British pounds and has a negative outlook for the British pound. So this is where you see them combining that fundamental economics with your currency strategies. So the question I have is, what option strategy could a manager employ to take advantage of this opportunity given the currency pair British pound per US dollar? This is critical. We must know the currency pair. So, what are you thinking here? Are you thinking, well, okay, we want to definitely sell the British pound forward. Oh, well, great. Well, we're not using forward contracts. We want to use options. So when we want to sell something, what do we think about? Oh, well, we think about probably a put option. Okay, well, what does this put option mean? Maybe we're thinking about going long a put option. Well, let's just look at the currency pair. British pounds per US dollar. The option refers to the base currency. So this tells me that I'm going to sell the US dollar. That is not what we want. So a long put option is not going to be the strategy that will help us here. So, I mean, I can put a strike right through that. That will not be our strategy given the currency pair. So what am I going to do for this currency pair? Well, I am going to then, let's see here. I want to sell the British pounds forward. And how can I accomplish this? I can go long a call option on the British pound per US dollar. So what does this do? This now locks in a price to buy US dollar, because the option refers to the base currency. Make sure you know about that. I keep saying it's all about the base. So if we lock in a price to buy the US dollar, then by definition, we are selling the British pound. So we have accomplished the strategy that we want. So there it is. Don't go too far. I mean, this is probably, the most confusing type of questions. Think about what you want to accomplish. Look at the currency pair, and that will give you the clue of what to do. So our learning outcome statements, what do they talk about? Now we've got it here, okay? We can put it together. Active strategies based on economic fundamentals. What are we going to do? You're going to read the question. Active trading strategies based on technical analysis. They might give us some clues there. The carry trade. When would we use the carry trade? Only if they tell us interest rate parity does not hold. Volatility trading. When would we do volatility trading? Well, if we believe that the markets are going to be volatile, if we have an opinion on this, that is what I think we need to be aware of. So the learning outcome statements then want us to talk about forward contracts. They want us to talk about an FX swap, which we handled at the beginning, and how we can use that FX swap. And then they want us to jump into the trading strategies. So where does this take us? Well, just following through here, they want us to talk about these currency management tools. So I talked about forward contracts. And if we completely hedge with a forward contract, we have a hedge ratio set at 100%. We've removed the currency risk. But we can start to adjust from that position. Language you should know: a static hedge and a dynamic hedge. So when should you employ a static hedge or a dynamic hedge? Again, you're going to read in the question here. If the manager really believes, this is it, that I believe that the currency is going to, move in a certain way, I think they'll just leave the hedge. Okay. If they have, are looking to, rebalance based on changing, yields, changing market conditions, then I think you can use dynamic hedging, where you continually readjust. But it may just come down to the portfolio manager and just, thinking about, what they say. So I wrote this down here in the bottom line just to think about this here. It could be a cost benefit if you're continually rebalancing, might be very expensive, or watch for these signals. I was trying to get at here. If you're very highly risk averse, okay, use dynamic hedging. I want to continually rebalance to remove that currency exposure. But if you have a strong commitment to your belief, you really believe the currency is going to move in a certain way, then just leave it. Okay, that's it. Static hedge. Okay, now our textbook, gets us into this cost-benefit trade-off, and now it focuses in on a specific area. So let's just demystify this, because it could really show up. It's looking at this roll yield. You're not doing any calculations really in depth. I just want you to think about the roll yield as the cost of hedging. That is the bottom line. So that is what I want you to take away. The cost of hedging is represented by the roll yield. Okay. So now, if you have an outlook on the currency and you want to hedge against that currency movement, we got to compare it against the cost. So I'll probably repeat this, but we're going to compare to our outlook for the currency. And this outlook for the currency just may be called the expected percentage change in the exchange rate. And there it is. They're just going to use this language. So we just have to focus in and be able to take this away. And I think we can very easily by knowing what we're looking at. I mentioned that we have a negative roll yields when you need to hedge by buying the base currency, when when the currency's trading at a forward premium, that's contango, or when you're selling the base currency at a forward discount. Is that really important? Maybe we'll pick up the signals here, okay? The hedging decision, this is very important. So this is going to link right back to what I just mentioned here about our outlook. So the higher the roll yield, the higher the cost and less incentive to hedge. Lower roll yield, probably more incentive to hedge, but we have to compare it to our expectations of the currency. Now, another very important point to be aware of, and I think this is coming on your exam, is the attitude of the manager. If they're risk neutral or if they're risk averse. And this will affect our decision to hedge. Even if we find that the cost is higher than the benefit, there's a net, a negative expected value of hedging, the cost is higher than the benefit, a very risk-averse manager may hedge. That's your CFA question. Your answer. I'll show you this right now, okay? So let's look at an example here. So again, this comes down to knowing what we're looking at. So here's the example. We have a U.S. manager. That's our home currency. We're holding investments in euros, Canadian dollars, Mexican peso. That's where our exposure is, okay? We're presented with the following data, Exhibit 1, 2, and 3. I made these up for tutorial purposes. And now our question asks us here, let's just scroll down. The portfolio manager decides to hedge against the euro, but not sure what to do relative to Canadian or Mexican currencies. Okay, fine. So question number 1 says, evaluate the portfolio manager's decision to hedge the euro. So how are we going to answer this? Okay, so this could be a written question to evaluate. Well, you're going to have to say whether it's a good decision or is it a bad decision. Okay, so I mean that's got to be worth a mark there. And then your justification, we're going to fill this in with a justification. So if this were to be a 3-mark question or a 4-mark question, it may just be 1 mark here just for saying did you circle or did you indicate whether it was a good decision or bad decision? And your justification, you know, this might be just worth 2 marks, and that's it. Our total question is worth 3 marks here. So how do we answer this? I'm going to go back up to Exhibit 1 here because Exhibit 1 tells me about the US dollar per euro. It tells me about the US dollar to euro here. And so the first question that I have is, given this currency pair, what are we doing to hedge? So let me just write it in underneath here. So we're going to hedge by selling this currency pair, by selling the forward. And why are we selling the forward? Because that means I'm selling the euro forward, which is what we want. So we're selling this euro forward, and now let's just look at this roll yield. It's negative. I mean, I know it's negative because the forward, you know, we're expecting this forward to depreciate. The forward's trading at a discount. So if you want to put together the statements and the previous page here about selling the base currency at a forward discount, we've got it. But let me just stick with this Exhibit 1 here. So we're gonna hedge by selling the forward, and here it is. The cost is 4%. We're gonna lose 4%, but this is gonna save us from losing 6% on the currency. That's what this tells us. This tells me that the euro, because it's in the base, is going to go down by 6%. So to answer the question number 1, let's just go down to question number 1. It was a good decision to hedge. That's what you're writing. It was a good decision to hedge. That was worth 1 mark. And your justification here, you're going to come down here, and what are you going to say? You want to be technical. You want to say the roll yield. The roll yield is less than the expected percentage change the exchange rate, that might be okay, but I would just put it into plain language. I would say the cost of 4% to hedge is less than the expected 6% currency loss. That is plain language. That is without a doubt telling the grader that you know what you're talking about, and that's got to be worth your 2 marks. So here it is. We're learning the techniques here. I'm just telling the grader, I wouldn't write good, bad with a slash. I would say it was a good decision to hedge. That's my evaluation. And now the justification. Here's my justification. I would write this down. Get rid of that technical points. Okay, I'm not trying to impress anybody. I'm trying to give the grader the opportunity to award me as many marks as I can in the quickest way possible. The cost of the hedge cost is 4% to hedge is less than the expected 6% currency loss. Okay, that's probably what I'm writing there, and that's my 3 marks. All right, let's look at question 2. It says, based only on the data in Exhibit 2, is the roll yield positive or negative for the manager? So this is probably just for tutorial purposes. Let's go back to Exhibit 2. And so we've got the Mexican peso per US dollar. So what do we have to do? We got to think about how we would hedge. So we would hedge. What would we do? We've got exposure in Mexican peso. So I don't want to sell this forward because that would be selling the US dollar. I want to hedge by buying the forward. All right, so I want to buy the forward. And now let's look at these forward points. Remember, right back to the basic material. What does this forward tell me? It tells me that we have a forward premium. So we want to hedge by buying the forward. That means we're buying the base currency when it's trading at a premium. Let me go back up to those bullet points. If we are hedging by buying the base currency, let's see here, when the currency is trading at a forward premium, we will face a negative roll yield. There it is. So you face a negative roll yield when you're buying the base currency, and the base currency is trading at a forward premium. Let me show you how to recognize that. We are hedging by buying the base currency forward, the US dollar, and the US dollar is trading at a forward premium. We know the roll yield is negative. There it is. So what is your answer if they asked you to justify this? Your justification, let me give you the words here. The words, again, they come straight from our bullet points. Okay. The justification is, okay, well, we'll leave it at that. Okay, we'll leave it at justification. The justification would be that we are hedging. We're hedging by buying the base currency forward, and the base currency is trading at a forward premium. Okay, and so this means therefore the roll yield will be negative. This leaves no doubt for the grader that you know what you're talking about. Now, for question number 3. Okay, this question number 3, I really think is the exam question. Here it is. Should the portfolio manager hedge the Canadian dollar? That's all that's given. Let's go back up here and look at this Canadian dollar. Here it is, Exhibit 3. US per Canadian. The roll yield's -5 or 5%. The cost is 5%. The currency is expected to move by 3%. What currency? The Canadian. So we're going to pay 5% to save a 3% currency movement? You might think that the answer to this is a big no. We should not hedge. No, do not hedge. Well, that might receive, maybe, partial marks. Maybe. Okay, I don't know. I mean, that might just receive 1 mark. You want the full marks, then to get full marks, I think that what you need to do is say, it depends. And what does it depend upon? It depends upon the attitude towards risk. So, and let me drop down right to my guideline answer. Here it is. Okay. So you're going to write this down in your answer. You're going to say that the cost of the hedge is greater than the benefit. So you may conclude that not hedging is appropriate. However, a risk neutral manager, you need to finish this off. A risk neutral manager would not hedge under these circumstances, but a risk averse manager might hedge under these circumstances. That is how you get the full points. So I want to be able to be your coach here, to be able to give you these lines so that you can get on this exam and you already have the answers. You're now just looking at the questions, making sure that you can fit it in and it's appropriate for the scenario that's given. So this is how we tackle this and turn it into an exercise of gaining the maximum points on this exam. And lots of candidates tell me that it's the morning session that really gives them trouble. The essay, they do well on the afternoon item sets, but then they fail based on their performance in the morning session. So if I can help you through our program here to get the language, the words to put on the paper, I think you're so far ahead of the competition, and then that's it. So now the learning outcome statements move on. Let's just drop over here. They just talk about, again, hedging with option contracts on currency. And we've already started to talk about this. Really what were they focusing on? They were focusing on put options, okay? And so talking about using put options. And the put options give us the downside protection and the upside potential. Using forwards, we're locked in. Remember, okay, just go back to level 1 thinking here, okay? Just remember that. So just be aware that your focus is on the base currency, and we've already talked about this. So if you go long a put option, you're selling the base. So make sure it lines up correctly. Now, the text also talks about trading strategies that reduce the hedging costs using options. Remember, options, you pay the premium. So I think you must be aware of this. So what do they talk about? They talked about, well, we could actually just overhedge or underhedge with forwards, because remember, forwards, we don't pay a premium. We could use out of the money options. What are out of the money options? What are you going to look for? You're going to look for the delta. Remember, the delta is going to be really low. It's going to be less than 50. It's going to be something like 10 or 15 or 5. Then you could also use combinations such as risk reversals. You must know the risk reversal. And the risk reversal, this is nothing more than a combination here where we have a long put and a short call to finance this. We could look at spreads. Put spreads, seagull spreads. So my advice is if options are not your strong point, don't spend too much time going through this. There may be some overlap in the risk management area where they do talk about option strategies. So you might get double your money there. So but I would say do not spend weeks on that. So I don't know if you'll be rewarded for it. Now, the remaining part of this material, they talk about hedging exposures to multiple currencies, and they want us to describe cross hedges, macro hedges, the minimum variance hedge ratio. So first of all, this is kind of misleading. This cross hedging, yeah, you might think about, using, one security versus another. They're pretty highly correlated. Yeah, that's great. Nice to know, level one. But in our curriculum, they start to talk about these natural cross hedges. So these are currencies that are naturally highly correlated. And you're going long one currency and short the other currency, and this creates the risk reducing characteristics. So look for natural cross hedge. That natural cross hedges, that's the level 3 application. A macro hedge, I don't think you're going to see this on the exam, but it was just thinking about reducing the overall risk of your portfolio. You're not really hedging one item here, but think about things like using indexed funds or using a safe haven security. They mentioned using gold as a hedge against bad times. So I don't think they're going too far with this. The minimum variance hedge ratio, knowing about using regression models to estimate the optimal hedge ratio. So now you think that sounds pretty difficult. I think they're just going to give you this. And I think that you just have to recognize that the beta right here, which is given, this will be the hedge ratio. And it will tell us exactly how to set up our hedge. So don't get bent out of shape here. We've got the regression and the beta, which may just be given. Or you could calculate beta. And remember from level 1, beta is, just think about the ratio of the, the standard deviations times the correlation. Okay, we may have to use that. I don't know, but I mean, it's just taking it back to the exact information, and we'll go through an example to finish it off. The last learning outcome statement is about looking at currency exposure in emerging markets. And this could just be a trivial, possible, qualitative, I think it's trivia, maybe qualitative. Just be aware that with the emerging markets, think about this: higher transaction costs, the illiquid, investments. There may be more volatility or extreme movements in the market. There may be currency controls. So these all make it more difficult to hedge. That's all. Now, to finish this off, here's a hedging learning example. Let's just put this together. It brings together some of the elements that we've talked about here. So pretty typical, I think. We've got this Bill, U.S. portfolio manager. Okay, so you're using our technique. U.S., that's the home. Okay, currency is U.S. We've got a global fund holding assets in euros, Canadian dollars, British pounds. This is the exposure. And now here's the link back to the economic fundamentals. The outlook for the Canadian dollar is negative based on the expectation for slower growth. Okay, all I had to know, it's negative. I think I got to cover that up. I got to be able to sell my Canadian dollars and get them back to my home currency. I already know where this is going. Then they give us information about, standard deviations and correlations of currencies. Oh, this is going to that minimum variance hedge ratio, that regression. Oh, they gave us the regression equation. And here, 2.55, that's already the hedge ratio. Let me make sure that I bold it and underlined it. I've got it. So now let me drop down to the questions. So question 1 says, given a Samarat outlook for the Canadian dollar, which remember was negative, what would be the most appropriate hedging transaction, assuming the quotation is CAD per US dollar and US per Canadian? So I just did this for tutorial purposes. What would we be doing here? Well, if it's CAD per US, remember what I want to do is go long. I want to go long a forward. This would buy the US and sell Canadian. So I would say long a forward. Okay, so boy, oh boy, wow, don't get bent out of shape here. What about for options? What would I want to do for options? I could go long a call option. And that means I'm going to buy the US dollar, selling Canadian. Watch out, really tricky. If the currency pair was given this way, oh, the exposure is to Canadian, and now what do I want to do? Oh, okay, I want to just, I just want to go short short this forward. Now we got it. That means selling the Canadian. Or I want to go long a put option. There it is. This allows me to sell the Canadian dollar and buy the US dollar. So make sure you know I'm emphasizing the currency pair. That is what is critical. Now, question 2 says, assume the portfolio holds 50 million euros in assets. Using the data in table 1, construct the minimum variance hedge ratio. So the data in table 1, we'd have to calculate the beta is what it's asking us to do here. So did we know what to do? Well, okay, we had to calculate the beta. And we know what this is. It's the correlation times the ratio of the standard deviations. Okay, well, let me just take a shortcut. I did the math. It's 0.36. So now, how do we use this? Well, I got to come back up here and I got to look at the table. Make sure you know how the currency pair is given. The currency pair is US per euro. That is critical because now when I set this up, let me just put it in here, USD per euro. Okay, well, now I know I want to short the forward. I want to short this currency pair, and that's part marks. Okay, so, how could we get some part marks? We could get some part marks by saying the minimum variance hedge ratio is equal to the beta from the regression. Okay, from the regression. Could you remember the formula? No. Okay, then leave it at that. Now, if they wanted to go further, then I would say, based on the currency pair, based on the US per euro currency pair, you want to short the forward. Okay, so maybe you're picking up some marks. Okay, I mean, if this is worth 4 marks or so, or if they wanted to show the calculations, maybe you're only picking up 1 mark, but it's better than getting 0. Okay, so now if you were to then, let's say you could not get this, let's say you could not get the beta, let's say you didn't know how to do the calculation. So then what I would do is I would tell the grader, I would say, assuming beta is equal to, and I would just make up a number, assuming beta is equal to whatever you want to make it. It doesn't even matter. It doesn't matter if it's 1.5 or if it's 0.5, whatever it is. And then I would continue because now the grader has the opportunity to follow through and see if you even know the process. Okay, so we're almost here. Let me continue on here with this these examples. So, you're trying to demonstrate, you're trying to demonstrate that you know the process. That's what this is coming down to, so that you can get some part marks. Are you going to get full marks? No. But it doesn't matter. We're trying to rescue some part marks. If you leave this blank, I know exactly what marks you're getting. You're getting 0. So then I would continue on, and I would just say, okay, so then you'd want to short, let's see, let's say beta times the 50 million. And this would be able to tell us the amount that we'd want to have in terms of the euros. So I'm trying to give you techniques to gain some part marks. If we go down to question 3, it says, using equation 3, calculate the minimum variance hedge ratio. Okay, I just threw this in here. Be aware it is given. Okay, so it is just beta is equal to 2.55. Okay, how do we interpret this? This means a hedge ratio equal to 255%. Okay, that's what we would follow through. And then question number 4, I don't know if 3 and 4 would be separate. They may just be together. So assume the currency pair is quoted as British pound per US dollar using equation 3 and assuming the portfolio has British pound exposure of 2 million. Outline the correct hedging strategy. So if this is worth 3 or 4 marks or so, what do we need to put down here? Okay, so we want to hedge So what do you're writing down here, okay? Just think about we want to hedge. Let's see here, by going short. Let's see here, short the British pound, okay, and we want to do this in the amount of well, how much? Well, what was beta? Beta was 2.55, and we'll multiply this by 2 million, and so now this is going to equal 5,100,000. So I've just written this down. We want to hedge, or we want to hedge by shorting, okay, the British pound in the amount of, don't let me not give away the answer here, of 5,100,000. Well, okay, now, how do we do this? Okay, so that's going to be the question, is how? Well, now remember, you've got to look at the currency pair. So the currency pair is given as British pounds per US dollar. So remember, what do we want to do? We want to sell the British pound. So if I short this currency pair, it means selling US dollars. So now I've got to come back and I've got to write down here. I've got to write down to tell the grader, I've got to say, because we're given the British pound per US dollar currency pair, we need to take a long position in a forward to hedge. Okay, and that is going to get you the marks. So now we filled it in here. So we've calculated the we calculated how much, 5.1 million, and now we've looked at the currency pair, and we have now told the grader, because we've recognized the currency pair, we need to take a long position in a forward a contract to hedge. And you may even want to go back, and even erase, we want to hedge British pounds in the amount. You might want to do that because you don't even want to leave any doubt for the grader to, possibly remove marks. So, I mean, the bottom line of what we're getting, onto here is that we are, in our programs. And I hope that you've enjoyed this introduction. In our programs for CFA, we are emphasizing an active learning approach. I think that if you take this from an exam point of view, then you will perform so much better on the exam. If you think that you're just going to read through the material and then get on the exam, and that's all you're going to do to prepare for this, I don't think you're going to be well prepared and rewarded. Okay, so our in-class programs, I'm just going to write this down here. In-class program, this is in Toronto. And this runs for 15 weeks, starting in January 2017, and runs all the way through till May. And then we have a final review, which is 3 days of really going through questions. I call it mini mock exams, and this is in Toronto, and it's also offered in Calgary, and this is in May, that late season, and then I even have an online program, which I call the Total Study Program, where I have these recorded lessons which go very similar to this webinar, where you see me talking you through the notes, going through examples, giving you the insight, what I try to do in class without all of the questions coming in class. So you're going through these recordings, and I want to tell you something. It's only about 20 hours. Okay? And that's on purpose. This is so that you can do this quickly. Okay? I really want you to be able to go through this material quickly and then repeat it and review it and do it again, so that what you study in, I have students who have signed up now, they started to go through this material. So, if you're starting to go through it and what you've learned in October, November, how do you retain this information? You can retain it all the way to exam day. Now, what else? Well, you've seen these notes, and so our notes, my notes, are about 400 or so pages, and they include coverage of the learning outcome statements. They include examples, just like what we were going through here, and they are focused on providing exam guidance. That is it. I really strongly believe that you can use our materials to get the foundation of your knowledge, and then you're going to combine with the CFA Institute practice questions, that are online, the mock exam questions, and even the end of chapter questions. And this is how you prepare for the level 3 exam. You get the overall understanding. There's not too many sections that are so technical. Okay? I keep saying level 1 thinking. Okay? And do not overthink it. Get the overall. Build your knowledge base. And then what I'm going to do, what my team, what we're going to do here is we're going to expand your knowledge base. Okay, we're going to expand your knowledge base. We'll put a P in there to expand. Okay, if I could spell it, we're going to expand your knowledge base. And what is this going to do? This is going to increase your marks. This is what is going to get you over the passing score. We want you to get this over and done with. That's it, on and earn the charter. Okay, so you put together the material, the recorded lessons. Everyone in the classroom program, gets access to the recorded lessons. Everyone in the classroom program gets access to all of the notes. Everyone in the classroom and even online, okay, they get access to all of this material. They get access to. I have a test bank of item set and essay questions that you can use, and you can go over them as many times as you want. So when you combine this with CFA Institute's practice questions, you are not going to run out of questions. You can go through these. If you find that you run out of questions, then turn to the blue box examples. What are the blue box examples? Those are in the curriculum readings. Okay, I want you to use the curriculum readings as a source where, if you're really stuck on something, you could use it as a source to possibly give you more explanation. But really what I want you to do is I want you to ask for help. Okay, if you're studying online with our program or you're in class, it doesn't matter. I want you to ask for help. You can do this by email. You can do this by phone, okay? And you can call in and speak to me, okay? And here's an 800 number, okay? 558-9796, okay? Or if you're in Toronto, you can call our local number here, okay? My local number, 416-318-4357. Okay? You can call, email, you want to text it, and you'll be surprised how quickly I get back to you in terms of the questions. If you send an email and it gets buried in my inbox, that's the only time I won't get back to you. I have a dedicated email for our level, and that's where you'll be sending your questions. But the bottom line is we are here to help you learn this material. Maybe a 5-minute conversation will save you an hour of reading. Okay, now this is not call up Brian and say, hey Brian, can you summarize page 1 to 100 in book number 3. No, that's not what this is. Okay, I mean, that's tutoring, and we do have paid tutoring if you wanted to do that. But this is, you're stuck on something, you're studying, you can't get it. Let's reach out. You've got somebody to help you through this. Okay, so I hope that you've enjoyed this online webinar. I hope you found it helpful. We had a little technical issues at the beginning, but you'll see the replay if you want to go through it. If you have any questions or want to follow up, you've got our phone numbers, our general email. It's on the bottom of every page here. info@examsuccess.ca. We've been doing this for almost 17 years with really excellent results and a lot of candidates going through and passing. So I want to let you know that you're dealing with an experienced group, a group that is also an approved prep provider from CFA Institute. So we participate in that program, and we follow their guidelines. And just to give you a little extra motivation, I want to tell you that I do have early bird specials, a little bit of a discount on some of the prices. So make sure that you check out the website because there's early bird discount. And I believe that there's a date coming up, October 17th, which, I think some of the prices start to go up, especially for the in-class and such. Again, I wanted to thank you for participating. This is Professor Brian Gordon from Exam Success, and I want to wish you a good evening. Thank you for participating.